Hi guys, a very good morning. So today is the 3rd of April. On Tuesday, we didn't technically have a class. Today, I'm going to look at again, guys. I have the latest material with me now. Okay, and today I'm going to look at property income. So till date, what have we seen? We have seen like the first three chapters in this textbook. Okay, I will just show it to you in brief before moving ahead. And most of the things, in fact, all of the things we've done in these first three chapters. There is nothing that is not done, and everything is in line with what we've seen earlier. Okay, for example, the first chapter was on, why do we do the taxation, the different types of tax that you have to study, direct versus indirect tax, structure of the UK tax system, sources of tax law. We've done this in detail. See the first class, sources of tax law. Okay. Then we looked at tax avoidance, tax evasion. That's also done. Then we saw professional ethics, right? Code of ethics, basically. We looked at the code of ethics. Dealing with the HMRC. We've seen all of this, we've looked at. So, first chapter, there is no problem. Second chapter, also again, personal allowance, a tax year, personal allowance, okay, accessible persons, married couples, civil partners, children. I told you all of that. Okay, taxable income, the pro forma we discussed. Then we've seen different types of income. And then personal allowance, I told you it's 12,570. And how to adjust, how do you get the adjusted net income? And how does the personal allowance drop? Also, we've seen, okay, we've done decent, reasonable amount of calculations. Ethan's example we saw, income tax liability 20, 40, 45%. There is absolutely no difference in that. 37 to 37,700. Again, we have 20%. We're taxing you at 20%. Up to 125,140, we're taxing you at 40%, and anything above that is taxed at 45%. So there's no difference. Order of, again, where is it? Order of deduction also is the same as we've seen earlier. There is absolutely no difference. Trading income is 21,000, employment income is 3,000 this for this lady, for Amir. Total income is 24, from which you deduct personal allowance of 12,570. So taxable income becomes 11,000. Because he falls within 37,700, he is paying taxes of only 20%. So his liability is 2319. There's nothing new at all. In this case, his income is 38,195. So up to 37,700, he is taxed at 20%. Tala's example I've done multiple times. At least 2 to 3 times I've done Tala's example. And then the remaining excess, whatever it is taxed at 40%. So his her taxable liability, tax liability is 7738. Thomas also we've seen reduction of personal allowance. Also, we have looked at. And if you remember, test your understanding too. We had looked at Abdullah, Alice, Aya. We've looked at everybody's examples. Right? Then comes savings income. We did this in the last class or the last to last class. I don't recollect. Probably on Friday we've done this. Savings income. We did it on Friday. Right? And I did tell you that 5,000. Remember, we've done a reasonable number of sums in this also, right? And there is no change in what we've seen. Okay, it's just normal. Whatever we have seen, the same thing. Jane received bank interest of 3,000. Calculate Jane's income tax liability, assuming she had employment income of 11,000. Right? So again, we did this sum. See, she has two incomes, non-savings and savings. So first you do non-savings. He has an income of 11,000, so deduct personal allowance there. So there is no taxable income. But she has savings income of 3,000. And the remaining, see, 11,000 of personal allowance has already been deducted from non-savings income. So only, see, personal allowance is 12,570. So the remaining personal allowance left is 1,570, which can be deducted from savings income. So the savings income that is taxable is 1,430. Right? Now, what is happening again is our income, that 5,000, remember that income of 5,000 up to that we can if our non-savings income falls in the category of 5,000, we in the savings income we will be taxing the savings income at 0%. So here, because we are falling within that 5,000 threshold, we're taxing the savings income at 0%. So the income tax liability is 0. Sneha, any doubts with this? No. Okay. Okay, so we've done savings income also. Quite a lot of questions we looked at. Dividend income also we did, but there is a small baby change in dividend income, which I'll come back to. So just dividend income alone, there is a small change. Nothing else is changing from what we have looked at already. Nothing else changes. So dividend income alone, I'm putting it in red, meaning that there is a small, tiny change. It's a very, very small change. So you don't need to panic. It's a very, very, very small change. Then we looked at qualifying interest payments. We've seen that again, there's a little bit of, just the order has changed, but qualifying interest payments we saw. Again, no need to worry, no major changes. Anwar and Mila's example we saw, both had the same income, both had the same amounts to be paid, but Mila had a lower taxable income. I don't know if you remember this. Sneha, you remember this example, Anwar and Mila? Yes. We've looked also at charitable givings. Again, no major changes. Everything is as usual. Remember, 80% you will pay, 20% the HMRC will pay when you give charity at the time of giving charity. And then after that, depending on which kind of taxpayer you are, there is further reliefs. Brinda's example we had seen, if you recollect. Paul and Grace example we saw. This was test your understanding 6 in the previous textbook. Here it has become test your understanding 9. This one, test your understanding 6, was Paul and Grace. And then test your understanding 7 was Claire's example. It has just the number has changed. Claire, this is a doubt which Aditya had asked. You remember, Sneha? So there's again no major changes. So I'm just going quickly through the new textbook just to show you that there's nothing, no major changes. Everything is as good, as comfortable as it was before. Then we move to the next chapter, which is additional aspects, where we're talking about again UK resident, not UK resident, 16 days, 46 days, if you recollect that. Automatic UK residency test, automatic non-UK residency test, automatic non-UK residency test, automatic UK residency test, and if you don't fall in both of the categories, Then there is a little bit of a gray area where we have to do a test on the ties that you have. Right? And again, there is no major difference here. This box, remember I had boxed this like this and said, this box is going to help you. Okay, so and again, we looked at Simon's example, which was also there in the previous class, which we did. We did Dieter's example and Fred and Olga. Fred, I had done. Olga, I told you to do on your own, with which that topic on residency rules was over. Marriage allowance, I gave an analogy of data being shared with your friend once your friend's data is over. Sneha, any problems with marriage allowance? Hope you recollect. Hi, Chirag. Chirag, we're just quickly going through the new material. See, I'm using the latest tax material. And I'm just showing again, if you've missed this and this is something that is of interest to you, you can definitely watch the first 10 minutes of this class on the recording. And I'm just showing to you people that there is absolutely no difference in what we have seen. Kevin and Judy's example also we had seen in the previous material. So Chirag, so far we're seeing if there's any change or if there's any difference, but there is nothing. There's no difference. First class, whatever we've seen, it is as it is. Second class, whatever we've seen, there's no difference. Third class, whatever we've seen, there is no difference. Fourth class, these topics, dividend income alone, there is a small change, which we will look at. If you remember Chirag, Kevin and Judy's example, do you remember us doing this for marriage allowance in the previous material? Same example, literally same example. Judy had unused personal allowance, which she could transfer to Kevin. You remember Chirag, yes or no? Sneha, you remember this example? We also looked at the example of Katie and Emily. Again, absolutely no difference. No difference at all. Katie and Emily's example also we saw. Child benefit, I told you, I just briefed you on that and I said we will come back. We didn't do any sums on child benefit because there is a small change. So we will definitely do child benefit, don't worry. And then we looked at savings account. And then we briefly looked at savings account. We didn't do much on that. We looked at this example of gilts. Ahmad sold gilts, which we did in the last class. And that's it. Chapter 1. Okay, so we've completed the 3 chapters, guys. The only thing that we need to look at, the only area where there would be a small difference is this child benefit, which we will look at. So what I'm marking is where we will revisit and just look at some key important points that you need to know. And dividend income. Apart from that, we've completed the first 3 chapters. And apart from that, I hope the first 3 chapters from your latest material are very clear and comfortable. Okay, so we are moving to the 4th chapter today, and I will want to complete the 4th chapter and move to the 5th chapter today. And before I start, of course, there is going to be 2 things that we have to look at. First, again, attendance I will take in because I don't have time. I should have already started by now. So attendance I'll take in the last 10 minutes when I give you time to review the topics. And apart from that, there will be an element of some announcement on the textbook, right? Today, we will upload the tax textbook and kit on the elements. So today we will upload the tax textbook and kit on the LMS. So that reminds me regarding your hard copy, your books, right? So I will just have it checked immediately. But please be on the watch out for the textbook and kit to be uploaded on our LMS. Okay, so I hope that is all perfectly fine. Today I'm going to start with property income. So, property income introduction. What is the introduction? See, if you have property, if you have a property, not a property, but if you have property, it could be single or plural, you can earn money from that property. You can earn money from that property. Now, is this a very big revelation? Oh, this is something you didn't know before? No, you knew this, right? How can you earn money from that property? You can earn money from that property in multiple ways. But the important thing that I want to tell you is earn from property. Meaning, this is something known as property income. And obviously, this is something that you are earning. This is something that you are getting, meaning that it will be taxed. Let's not dig too much deeper into that. Don't worry. As of now, let's just imagine a happy scenario of our life where we have a property, right? How do you think you can earn from that property? You can earn from that property in multiple ways. Number one, you can give it on rent. So all you have to do is, guys, we will open 99 acres, we will open Magic Bricks, we will advertise our house on rent, and somebody will come and take the house and pay us monthly rent, monthly or quarterly. Right here in Chennai, at least I pay monthly rent. Where I used to live before, we used to pay quarterly rent. So now that depends. But you can earn rent, or you give the property up on lease, lease out the property for a certain period of time and get a lump sum amount. Again, a part of that lump, okay, let me not dig deep into that, but a part of that lump sum amount will be taxed. How else do you think you can earn from property, guys? Another way of earning from property. Well, you can turn your property into a furnished holiday accommodation, like a short-term rental. This is something that I'm very interested in. I don't know why, but I'm really interested in kind of doing this short-term rental business. Take a small studio in some nice city in a prime location and rent it out for like short term. So it will be like a furnished apartment where you can stay for 4 days, 5 days, and you will pay me rent. That is one way that you can earn from property. Or you can rent out a room specifically, which we will look at in more detail later. right? So this is the brief introduction to property. Okay, and property income. So the income that you earn from property, either by renting it out or leasing it out or turning it into a furnished holiday accommodation, whatever you earn is property income. Now, the next thing that you have to look at is when do you, so I'm going to make this as, I'm going to keep headings now, just to improvise on the overall quality. I am considering putting things down and uploading notes on there. I can't promise, but I will try to, right? You can earn money from that property in multiple. Okay, you can earn money from that property in multiple ways, right? Which is mentioned below. You have property, you can earn from that property. This is property income. Why? Because two important words. You can earn from that property. So you are getting an income from that property. You earn from the property, which means it is property income. And you can earn it in these multiple ways. I hope this part is clear and comfortable to everybody. The next thing that we are going to look at is on certain important dates and timelines. Okay, and I would want to say basis of assessment. Basis of assessment paragraph. What do I mean by basis of assessment? Again, you need not look at the textbook. I'll explain it. But normally, in basis of assessment, what we are trying to tell you is normally, when do you pay tax on property? Is when you get the money in hand. You normally you pay tax. You pay tax on the property income when you actually receive the money, when the cash is actually received, or when the cash flow actually happens. When the cash flow actually happens. Now again, there is an accruals basis which we will look at later in this chapter. But normally, what we need to know is you pay tax on property income when you actually receive the money, when the cash flow actually happens. It does not matter when the rent was due. It does not matter when the rent was due. I can give you an example for this, right? The example is going to be, for example, if you receive rent on, say, 1st of April 2024, for the period, for which period? For the period April, May, June of 2020, of the next year. For the period April, May, June. Now you know that we are talking about the next tax year, correct? Or say you paid it on 30th of March, even better. 30th of March, April, May, June. Now, although you have paid it for April, May, June, you received the rent on 30th of March. Therefore, you will tax it for this tax year because the cash is received. Are you understanding? If you receive rent on 30th March 2024 for the period April, May, June, you will tax it, or you will be taxed for this tax year as the cash was received this year. Okay, so this is known as the cash basis. This is known as the cash basis. So I hope this method and basis is clear and comfortable to all. So we've seen what the cash basis is, right? And as usual, we know the tax year 6th of April 2024 to 5th of April 2025. Here, although you've paid it for April, May, June, for the next tax year, you've paid it this year, therefore it will be taxed this year. Okay, now again, moving on, let's keep things simple and easy. How do you calculate the tax income? Sorry, not the tax income, the rental income. See, it's very simple. It's like a business. How do you calculate the taxable income for property? It's very, very simple. It's like doing a small trading business. Just imagine a small trading business. So in a small trading business, say I sell pens. So the selling price is $10. So this is the income earned. The cost is $2. So my profit is $8. Correct? This is what, again, I'm going to remove this. It's not going to be part of the notes. I'm going to remove this. But this is how you would calculate your income, right? Revenue minus cost is your profit. You will apply the same concept. Imagine you are a small trader. How do you selling pens? How do you calculate the profit? Let's keep life simple. How will you calculate profit? Okay, examples I'll put in green. Selling price is 10, cost is 2, profit is 8. Similarly, for property income, what we will do is we will look at the income received minus the expenses paid, just like the previous example, just like the example mentioned above. Just like the example mentioned above. So what will we do? It's like this. It goes like this, right? It will be rental income received minus expenses paid in relation to the property. Will give you the taxable income. Right? So say the rental income received was 5,000. The expenses paid were 2,000 in relation to the property. So the taxable income would be 3,000. And again, remember, all of this is on a cash basis. So we're not talking about the rental income that was due. We're talking about the rental income which was actually received in cash. Similarly, we're not talking about the expenses that were due. We're talking about the expenses that were actually paid in cash because we're following the cash basis. Remember this. Okay. So this is, I hope, very clear to everybody. Okay. Now, remember I told you this part, expenses paid in relation to the property can be deducted. You basically have to subtract. Please don't sit and add. These are expenses. Now we are going to zoom into this part. So I'm going to highlight this in blue. Blue, I'm going to zoom into that part basically. And I'm going to tell you which expenses can be deducted. Can you deduct any expense of your choice, anything based on your mood, based on your wish? No, that's not the case. Right? So, which expenses can be deducted? I'm going to explain in this section, which is going to be the fourth topic covered today. And what's the fourth topic covered today? Which expenses can be deducted from the income? Which expenses can you deduct? Which expenses can you not deduct? All right. So let's look at that in brief. Again, certain expenses are deducted. What are they? Expenses. Which expenses can be deducted? Again, this is a headache. Okay, the reason I'm doing it in so much care is I intend to just upload this on the LMS. Which expenses can be deducted from property income? Again, any expenses that were incurred in, say, maintaining the property could be an example. For example, any repairs and maintenance. Because obviously, it is an expense of keeping that property. No? If you have property, every now and then there will be a repair. Like, for example, if you come to FinChartered Academy right now, just walk into FinChartered Academy. We have a property here. We have an office. Just walk in. And when you walk in, and there's a room inside, which is our office room. So there's a classroom where I sit and take classes. And there's a room inside, which is our office. So the admin people sit there, admin accounts, those guys sit there. Right? So with respect to our office, if you go inside, one of the bulbs is blinking. I mean, it's not working properly. So we'll have to kind of repair it. Right? This expense, obviously repairing that is not going to be free. This expense is money that you are incurring to maintain the property. And therefore, it can definitely be deducted from property income. Okay. You can also deduct allowed expense would also be insurance. You may also deduct interest on loans. More on this later. But remember, this is for non-residential property. And any costs incurred before renting out the property. Incurred before renting out the property. So let me not mention it that way. But agent fees, management costs, etc. As I said, look at this sentence. However, there are special rules which apply to the financing cost of a let of a let residential property. See, residential property, non-residential property, we're going to look at both this in more detail. Okay, so let's look at illustration 1. Okay, so we're going to look at illustration 1. Again, please, no need to look at the answer. But what does illustration 1 say? Hembry owns a property that was let for the first time on 1st of July 2024. The rent is 5,000 per annum, is paid quarterly in advance of the first of the month. Hembry paid allowable expenses of 200 in December 2024 and of 400 in May 2025 for work that was done in March 2025. Now, again, this illustration simply is checking if you understand the cash basis, nothing else. So this illustration is simply checking if you understand what the cash basis. Now, the first thing is you've received 4 payments. We don't care when it was due, but we just know that we've received 4 payments. The rent is 5,000 per annum, paid quarterly in advance. So you know that this year, irrespective of when the rent is actually for, we have received 5,000. So again, implement this formula. Rental income received, just copy paste it. That's why I took 5,000 here, because I knew this example was coming. The rent received is 5,000. So, I mean, I don't care when I received it. I just know that I received cash 5,000. So I'm just taking that 5,000 into consideration. And simply deduct the expenses paid. And there are 2 expenses paid, 200 and 400. As I said, this illustration is simply checking if you understand the cash basis. What do I mean by that? See, I paid 200 in December 2024. So I paid it this year. So the cash was actually paid this year. Where is it? The cash was actually paid this year. Therefore, I can deduct it. I can deduct it as an expense for this year. Expense, which expense is this? Pipe expense. So I can deduct it. 200 to be deducted. But look at this $400. Yes, this is work that was done this year, in this tax year. In March 2025, it was done. I agree with you. I agree the $400, although was paid for work done in this tax year, the amount was paid only next year. See, when did I pay the amount? I paid it in May 2020. Therefore, as per cash basis, I will not deduct this 400 this year. I will deduct it as an expense next year, because cash basis says what? Cash basis says that it does not matter when the rent or expense was due. Rent or expense was due. We are bothered about when the cash flow actually happens. That's why I said this illustration is simply checking your understanding of the cash basis. So the 400 is not deducted in this tax year. Therefore, the property income for this tax year will be 5,000 minus 200, which is 4,800. Illustration 1. Right. So the repairs expense incurred in March will be paid in tax year 2025, 2026 when we paid it, not now, because we are following the cash basis. So I hope this is clear. It's very easy. It's very simple to all. Okay. So I hope life is simple, easy, very crystal clear. Now, what is the next thing that we are going to look at? See, we're going to look at financing costs. And let me try to explain this with the help of illustration 2. What does this illustration say? Adam owns a residential property that he lets out. During the tax year 2024 2025, he received rent. Guys, 1 second. Okay, yes. I just given this sudden panic attack whether the class is being recorded or not. By God's grace, we are being recorded. So he received 15,000 and paid the following. So it's very simple. 15,000 minus the expenses that were paid, not incurred, paid this year. So agent fees, insurance, gardener's cost, interest cost on loan acquired, on loan to acquire property. Now let me tell you that illustration 2 is the new thing in illustration 2 is this. The interest cost. That's why the topic is financing costs. You understand? So the new thing in illustration 2 is this part. Everything else we should be able to do. This checks you on financing cost. Right? So let's continue. Let's do this illustration. So illustration 2, again, it's an example, like the textbook example. So I'll put it in blue. My examples, I'm keeping it in green. So illustration 2, it's very simple. This illustration is checking your understanding of financing charges. So again, how much is the rent received? The rent received is 15,000. Correct? That is how much you are receiving. I hope that part is very clear, crystal clear and easy. So again, make a note before I put it. Try it. I'm going to give it a couple of seconds before I start. Rent received is 50,000. Agent fees, remember, agent fees can be deductible. So don't worry, agent fees, we know what to do. Insurance, remember, insurance can be deductible. Again, I'm giving you some clues. Gardener's cost. Gardener, I feel, is somebody who is needed to maintain the property, right? Because obviously, without the gardener, we will have a little bit of a problem because there'll be your building will just keep, sorry, not building, but there'll be big trees growing suddenly over there, right? So gardener, okay, 1,300. Maintenance, it will fall in the maintenance category. So again, as usual, Now I will start. Rent received is 15,000. Agent fees can be deducted. We know that insurance can be deducted. I know that gardener's cost is a maintenance cost, can be deducted. I know that what to do with interest cost alone, I will tell you. Everything else is simple and easy, right? Now, when it comes to interest, when it comes to finance charges, as per the new rule for finance charges, as per the new rule, what you will do is, again, the new rule is a little bit of a bad news for a few people. We will look at that. But as per the new rule, according to the new rule, what is happening is you get a tax relief of 20%. That's all. You get a tax relief of 20%. Before, life was better. Before, you could deduct the interest from the rental income directly. Where is that mentioned? So, owners of buy to let residential properties were historically able to claim a tax deduction for their loan finance cost. The cost used to be deducted as an expense. So, the finance cost of 7,500 could be deducted as an expense. But what are we understanding now? You get a tax relief of 20% on the interest. Meaning that if interest is 7,500, you will get a relief of 20% on that. Are you understanding? You will get a relief of 20% on that. That is all. Again, let's just keep this separate. Okay, let's just keep this aside. But that is all. You cannot deduct the finance charge as an expense. Before you could, but now finance charge will not be deducted as an expense. Again, you will just get a tax relief of 20%. We will adjust that later. But remember this, here you cannot deduct it as an expense. Do you understand? So in this case, 15,000 minus 1,000 minus 1,500 minus 1,300 will be 15,000 minus 3,800 basically. So 15,000 minus 3,800, your property income becomes 15,000 minus 3,800 should be 12,000, 8,000, 11,200. Your property income will be 11,200, guys. I hope this is clear. I hope this is very, very easy. Now that you know this, you can continue to do this sum as usual. What do I mean by continue to do this sum as usual? Again, remember, there's another piece of information. He has a trading income. He has non-savings income of 42,000 and he has savings income of 800. This you will calculate just like how we did in the previous three chapters. So non-savings income he has, okay. How much is it? 42,000, right? I hope this is clear. And he has property income also of 11,200. See, we just calculated. The property income will be 11,200. I have deducted the expenses and all that, yes. But for tax purposes, the income will be, it's like the profit. It's like the earning. The earning is 11,200. So that is what will be taxed. Therefore, his total income is 42 plus 11, 53,200. So his trading income, his property income. So his total income is 53,200. Now you know that there is something known as personal allowance. So you deduct the personal allowance because he is under 100,000. You deduct the personal allowance of 12,570. There's nothing new here. So 12,570, if it is deducted, the taxable income, I'm just moving this to the next page. How much is the taxable income, guys? 53,200 minus 12,000. Quickly, I need answers fast. Chirag, Sneha, 40,630. Very good. Once you have 40,630, that's your taxable non-savings income. What about your savings income? We've calculated this in an earlier chapter. Okay, you have a savings income of 800. Again, there is no personal allowance here because personal allowance has entirely been exhausted. So the taxable income here will be 800. There's nothing new here. So you have 40,630 plus 800. Therefore, the total taxable income will be 40,630 plus 800, which will be 41,430. Total taxable income will be 41,430. So now you know very well that there is what? There is, we are up to 37,700, we will be taxing ourselves at 20%. After that, we go to 40%. So we are a higher rate taxpayer. So as usual, we will do, again, we are ignoring this for now. Which part are we ignoring? This part we will ignore for now. As of now, just know that there is no deduction of finance charge. Later, I will come and give you a relief. But right now, finance charge, you are not even touching it. What do I mean by not even touching it? Remember, we did not deduct it as an expense. We are taxing everything. Right? Now, what happens is, again, your non-savings income is again up to 37,700. You are taxing ourselves at 20%, which is 7,540. No need to calculate this because we know this figure. Then anything in excess of that is how much? Again, we're doing the non-savings income. How much is the excess? 37,700. And remember, 40,630. How much is the excess non-savings income? 40,630 minus 37,700. 40,630 minus 37,000. 40,630 minus 37,700 is 2,930. So the remaining amount left of non-savings income is 2,930. Again, taxed at the higher rate of 40%. So 40% of 2,930 will be 1,172. This is your non-savings income. Then you have what? You have the savings income. All right. So what is the savings income that we have? We have a savings income of 800. All right. So again, if we've gone through the savings income, remember, going to that specific topic which is just done off late recently. I think last class we looked at that. Yeah, savings income, right? Again, what is happening? We had looked at this and we had done some sums. Remember? So the first, where is this? Yeah, this part. For a higher rate taxpayer, the first 500, again, ignore the fact that we don't fall in this 5,000 category. Again, the ones who are watching this recording for the first time should definitely watch the previous recordings where I explained all this in a lot of detail. Please don't watch further, go back and watch it. But again, the higher rate taxpayer, the next 500 falls in the saving income nil rate band of 0%. So what is happening is, go back to chapter 4. Again, whoever wants to brush themselves up on that, please do watch the recording, do the sums. But we've seen this already. The second, see, forget the fact that we don't fall in that 5,000 threshold. It's okay, fine. But the next 500, where is it? Will be taxed at 0%. So out of 800, 500 is taxed at 0%. And after that, anything in excess of that will be taxed at the normal 40%. First 500 is taxed at 0%. Into 0. Then the remaining 300, that 300, 40% of 300 will be 120. Therefore, the total taxable income, the tax liability will be 7540 plus 1172 plus 120. Who can calculate and tell me this? 1172 plus 120 plus 0. Obviously, 0 is something you're not going to. It's not. But if you add this up, how much? 8832. So your tax liability will be, technically speaking, your tax liability is supposed to be 883. But here at that stage, at this stage where you have the tax liability, at that stage, what will happen? Guys, just excuse me, I'm just looking at. At that stage, what will happen is we go back and say, oh, but there is interest that we are paying, 7,500. Because remember, we had not deducted it from expense. So now for that 7,500, I'd say you'll get a relief of 20%. So you deduct it at that stage and say you get a tax relief on finance charge of a maximum of 20%. So 7,500, 20% you don't need to pay. So 20% of 7,500 will be 1,500 as I'm able to see on my calculator. So this is a relief, no need to pay this. Therefore, your income tax liability will be 8832 minus 1,500, 7,332. With which this illustration is over. I'm just going to kind of make sure it's a little more legible. Legible as in it is legible, but I mean a little more attractive to look at. But again, meanwhile, all of you just see if everything's clear and comfortable. We will also refer the answer, don't worry. So this is the question. So illustration 2, guys, is it crystal clear? Guys, is this crystal clear? No problems at all? This is what financing cost says, with which financing cost is over. Okay, as per the new rule, you are not deducting the finance charge as an expense from the rent received. It is simply taken, we simply take a what? We simply take a relief of 20%. That's all. And you see the answer is 733. You can cross check all the answers. 41,430. There's 41,430. Okay. Now, the next thing we're going to look at is capital expenditure versus revenue expenditure. Versus revenue expenditure. Now, again, the textbook says capital expenditure, then it talks about an example. So, we will do this. Right? So, here, what happens is this. Look, it's like obviously when you have a rental property, okay, I'm just keeping this as per the textbook so it's easier for you to locate. But when you have a property, you will definitely spend money on that property, right? But which money, how to treat, what expense, how to treat is what you will look at. So this topic simply says when you have property, you will spend money on the property. Yes. But again, we've seen that we deduct expenses from the taxable income, right? Not all expenses can be deducted from the income. Right? We need to understand that there is some income that is, some expense that is incurred for maintaining the asset, right? Which I would like to say is, say, repairs. These are costs to maintain the property in its current condition. Accruals basis we'll look at, don't worry. I'm just looking at, okay, never mind. So these repairs are repairs, these are expenses to maintain the property. And this, as we've seen, is allowed as an expense. Allowed as a deduction. Right? So these expenses are more like the expenses to run the rental business, like to for the revenue to come. So they are deductible. Examples will include replacing broken tiles, fixing a leaking pipe, repairing walls, repairing floors, walls due to wear and tear. These things are deductible. But as I said, not everything is deductible. Not all expenses are deductible. There is something known as capital expenditure. These are expenses that are kind of major expenses that are incurred for upgrading the property, improving the property. Right? So here, again, what we have to look at is these are major upgrades or improvements. Right? So we look more on that shortly. Okay, but here all we need to know is here these are not allowed as a deduction. See, we need to distinguish between capital expenditure and revenue expenditure. So revenue expenditure is what I mentioned here. So I'm putting that as revenue expenditure. We need to know the distinction between it. Then comes capital expenditure, where these are major upgrades, major improvements, right? So as you can see, these are not allowable for deduction. So as you can see in your textbook, repairs, that is revenue expenditures, are allowable, but improvements are not allowable. And that is what we are talking about in the notes as well. Okay, so guys, again, say you want to add a new room, you want to upgrade your kitchen, you want to upgrade the bathroom, those things are not allowed for a deduction. Okay. Now, you can read this. Caution is required when an item is needed for of repair, is in need of repair. Repair means restoring of the asset by replacing it with whatever, right? You're just fixing the damage. But significant improvements, if significant improvements are made to the asset where it has improved better than the previous time, that is a capital expenditure. So revenue expenditure is money spent on maintaining the asset, simply maintaining it in its current form. Capital expense is major updates or improvements where money is spent on improving the asset. They are deductible. Sorry. Wait, did I say they are deductible? These are allowable for deduction? No. Are they allowable for deduction? They are not allowable for deduction. Right? I think I mentioned it here. These are not allowable for deduction. Probably it was a spelling mistake or a typing error. But these are not allowable for deduction. So remember, how did I start this topic? I said that when you have a property, you will spend money on it, but not all money spent on this property can be deducted as an expense. Money spent for revenue expenditure can be deducted, but capital expenditure will not be deducted. Guys, is this clear to both of you? Yes. Now we're talking about replacement. I'll come back to cars, but we're talking about replacement of domestic items, right? Which is a replacement domestic item relief. It's like, say, you have a fridge, replacement domestic items relief. Say, for example, you have a fridge. Right? This is where, again, you are talking about a furnished residential letting. There is some relief on replacing furniture. What do I mean by some relief on replacing furniture? If you replace an item like furniture, fridge, curtains, microwave in a residential rental property, you can get this relief that I'm talking. For example, you replace the old fridge with a similar new fridge. The important word here is similar new fridge. It should not be a new improved fridge, because if it's an improved fridge, then there's an improvement. Remember, we're only maintaining here. In this case, there is you are allowed to kind of get a deduction. Here, you are allowed to get a deduction. Right? Remember, the important word is similar item. It should not be an item which is an improved item. For example, if you are replacing your old fridge with a new fridge, yes, it is allowed. But if old fridge is replaced with, say, a new sophisticated smart fridge, old fridge is replaced with a new sophisticated smart fridge, then there's a problem. Here, this will not be allowed. Okay, guys, I hope this is clear and easy. And also, Amal is driving a car also. So I have to do car thing also so that you are able to understand. So again, with respect to cars, we looked at replacement and now we're looking at cars. So when it comes to cars, again, we'll look at this in a lot more detail in a later chapter. But if you use a car for managing your rental properties, you can get a tax reduction, which is something we will look at in the coming illustration. For example, this lady is driving a car of 120 miles, right? So what you can do is HMRC has this allowance. So HMRC has an allowance where they are saying for the first 10,000 miles, for the first 10,000 miles, you get an allowance of 45p. P means pence, penny, pence. Plural of penny is pence. 45 pence per mile, you get an allowance. You get like a deduction. After 10,000 miles, you get an allowance of 25 pence per mile. Again, we will look at this in more detail in later chapters, but this is what it is. Okay. So I hope this is clear. And now we can look at an example from the text. And we're looking at illustration 3. What time is our break, guys? 11:25? Oh God. Oh, my bad. Okay. So, guys, we will continue from illustration 3. 11:30, you can take the break. That is in the next 1 minute. We'll come back from the break and complete the 4th chapter. Today, we will for sure complete the 4th chapter, and tomorrow I'll try to do the 5th chapter. Where are we? Illustration 3. Okay, so come back at 11:40. So this is something that should be avoided in the future. Guys, if I forget, please let me remind me about the break, 11:25 sharp. Okay. Anyway, it's 11:30. Come back in 10 minutes. Yes, guys, welcome back. I'm going to give you a couple of minutes further to just have a look at what we have done so far. Just 2 minutes. I'm pausing this recording, but the ones who are watching the recording also just pause and see if everything's okay so far. Yes, let's continue. Is it all okay? Simple to everybody? Chirag, Sneha, is this easy? Everything that you see on the screen, everything that I've done? Okay. Now let's look at illustration 3. We're going to see Amal. Amal owns a cottage that she lets out furnished at an annual rent of 3,600. Okay. Um, Payable monthly in advance. Okay. She incurred, so her revenue is 3,600. But the problem is the tenant had vacated the property during June 2024 without having paid the rent due for June. Do you understand? So although we are supposed to receive 3,600, illustration 3, although we are supposed to receive 3,600, sorry, 3,000. Although we're supposed to receive 3,600, 1 month of rent we did not collect. Rather, let me rephrase that. We were not paid. So out of 12 months, if the rent is 3,600 for 12 months, the rent is 300 per month. For which 1 month rent we did not collect this year. We did not get it. The tenant didn't pay us. And Amal was unable to trace the defaulting tenant. The tenant ran away. Okay. So out of 3,600, 1 month rent I did not get. Therefore, only 3,300 is the amount that we received. Right? So annual rent is 3,600. Rent per month will be 3,600 divided by 12, which is 300. Then what happens? 1 month rent was not paid. Therefore, rent collected will be 3,600 minus 300. So the rent collected is 3,300. The new tenants paid a security deposit SD of $800, but this is, I mean, security deposit is like a refundable amount. So, I mean, this is not something that we will take into consideration. As in, this is not an amount which is going to really be calculated, right? So at the end of the period, you know, right, security deposit has to be given. This is not taken as money income. So we will not do anything to account for that 800, at least over here in tax purpose, right? This is not taxable income. Taxable income. So just ignore that 800. Okay, so I hope that much is clear. Annual rent received is 3,300. Then there were certain expenses incurred, right? So rent received is 3,300, and then expenses. How do we deal with the expenses? Replacement bedroom curtains. Now again, remember, it's a replacement. Without having any further information on this, no, it's a replacement. So The replacement amount we've seen, it is allowed old curtains for new curtains. So it is, you can deduct it. 150. Replacement. 150. Okay. Replaced curtains, just to keep it like aligned, I'm just using a smaller word. Replaced curtains, 150. Then we have uh, repairs, replacement of one broken kitchen unit in a fitted kitchen with a unit of similar standard. So again, we are replacing a similar item. So again, it's a replacement only item. Replaced item is 275. Again, it's just a replacement, so there's no problem. Insurance from 5th July 2024. Remember, insurance we've seen earlier, we deducted 480. Dishwasher, when it comes to the dishwasher, 380. Any news about the dishwasher? A dishwasher had not previously been provided in the property. So here, what is the thing? What is it that we have to look at? See, this is something that we don't allow. How? Look at this. Expenditure on an asset provided for use in a residential property is not an allowable expense, nor are capital allowances available. So the dishwasher is not a replacement. So as a dishwasher is not a replacement, there is also no relief under the replacement domestic items provisions. So the dishwasher, there will be no deduction for the dishwasher. Okay. Then comes redecoration. Redecoration is, oops, sorry. Where is the redecoration? Redecoration is 750. Right? Again, it's under the cash basis, a deduction will be allowed for the redecoration cost paid in May 2025 because we have to follow the cash basis. This redecoration was paid when? May 2025. So in the next year. So here redecoration will not be deducted. Okay. So here what is happening is it's going to be this much. And apart from that, Amal drove 120 miles in her car in relation to the property business. So 120 miles Amal drove. 120 miles. And again, we saw earlier that up to 10,000 miles, there is 45 pence per mile as an allowance which can be deducted as per the HMRC. So 120 into 45 pence. 45 pence is 0.45 pounds. So 120 into 0.45 is 54. So again, this is an allowance. Amal drove 120 miles. Again, I'll put it in detail. Drove 120 miles. And as per HMRC allowance, for the first 10,000 miles, there is an allowance of 0.45 pence per mile. So, therefore, the allowance will be Therefore, the allowance will be 10,000 into 0.45. So 10,000 into 0.45 is 54. Okay. So the car allowance for the car is how much? 54, which can be deducted. Therefore, the expenses are totaling to 150 plus 275 plus 480 plus 54. How much is it? Total 150 plus 275 plus 480 plus 54 is 959. 959. So 3,300 minus 959 will be, how much will the property income be? 3,300 minus 959 is 2,340. That's it. End of the question. So guys, illustration 3, just have a look and tell me if there's any problem at all, because now we move to the next part. Okay, any problems? Perfect. Now we will go to property income accruals basis. So if you've understood cash basis, accruals basis is very easy. This simply says that we will tax, or rather we will recognize income and expenses not when the cash is paid, but when the income or the expense is due. See, in cash basis, what do? We recognize income and expense when the cash is, depending on the cash flow, basically, when the cash is paid or received, not when it is due. But in the accruals basis, what will we do? We recognize income or expenses. You recognize income and expenses when they are due, not when cash is paid or received. It's the opposite. Okay, so I hope this is clear about what accruals basis is. It's just the opposite of the cash basis. And normally we've seen that we use the cash basis, right? Normally, the cash basis. Normally, that's why I taught you the cash basis first, and that's why even the textbook is talking about the cash basis first. But normally, individuals and partnerships use the cash basis. However, if your property income exceeds 1,50,000 or 150,000 pounds, you have to move to, you use the accruals basis. And obviously, in the exam, you will use the accruals basis only when you are mentioned and told. Right? So we're looking at the key differences between cash basis and accruals basis. Cash basis, you can put it in your notes like this. Okay, and accruals basis. Cash basis is you recognize when cash is paid or received. Accruals basis, you recognize when the amounts are due. Recognize when you recognize income or expense, basically, when amounts are due. That's the first major difference between cash basis and accruals basis. The second difference is, again, in cash basis, if the tenant did not pay rent, like in case of Amal, not in case of whose case it was, yeah, in case of Amal, $300 we had not received from the tenant. 1 month rent we had not received, so we did not tax it. So in case of cash basis, if the tenant did not pay the rent, we don't tax it. For example, in Amal's case. But in case of accruals basis, again, you recognize amounts when they are due. So you still tax the rent, the unpaid rent. As income. But if it remains unpaid, like in Amal's case, so in accruals basis, you will add up that 300. See, in tax basis, you didn't add that 3. But in accruals basis, you have to add it. If it still remains unpaid, in that case, what do you do? If it still remains unpaid, then you claim it as a bad debt. Oops, sorry. You claim it as a bad debt expense.
It's 12 o'clock.
Right? So that's the second difference. Here it is mentioned, but again, I don't want to leave you with paragraphs. So keeping a table like this will be easy for you to see and differentiate. Okay, so cash basis, accruals basis. Both bases, I hope, are very, very clear. Next is equipment cost. So when it comes to equipment cost, the third difference, again, this one, plant and machinery, so on. The other main difference is that expenditure on plant and machinery used in a property business, such as tools used for maintenance of the property or office use used for running the business, is not an allowable deduction from the income. However, capital allowance are available later. Okay, so here in the cash basis, you deduct the cost, okay, the expense for tools. Now, again, this is where I think tools was something that we did not look at in full detail. Expenditure for cash basis, expenditure on property used in a property, such as tools used for maintenance of the property, is an allowable deduction from the income when paid. That is with respect to cash basis. It is an allowable deduction, right? So in case of cash basis, it's an allowable deduction. You can deduct the cost of tools and equipment. But in the accruals basis, you don't deduct the cost. It is not an allowable deduction. Again, we will look at in later chapter how do we deal with that. But for now, at your level, you just say it is not an allowable deduction, unlike in the cash basis. Right? That's it. Right? So I hope the differences are clear between the cash basis and accruals basis. In your textbook, in your notebook, you can put this in a table. In pages, I may not be able to. Pages, this is the tool that I'm using. And in pages, it's generally very difficult. I'm not very familiar with how do you. But you can for sure put it in a table. Okay. So these are the differences, the cash basis and accrual. And I told you what is the cash basis. And I have also explained to you what is the accruals basis. I hope everybody is happy. Okay, Chirag, you are happy? Okay. Now we will look at illustration 4 with the knowledge that we received just now. Okay, so we're moving to this illustration of Aubrey. Okay, and again, you don't need to look at the answer, I explain it to you. Illustration 4. In illustration 4, what is happening? The Aubrey owns a property that was let for the first time on 1st of July 2024. The rent was of 5,000 per annum is paid quarterly in advance. Aubrey paid allowable expenses of 200 in December. So again, you know it's an allowable expense, so no need to worry about it. And 400 in May 2025. I don't know how many of you are noticing, but this is the same question which we saw. It is the same as illustration 1. I don't know if you notice. Hembre, Obre is the same thing technically. But the only difference is Hembre was using the cash basis. And Obre is again the same, numbers are all the same 200, 400, 5,000. But in Obre, we're doing the accruals basis. That's the only difference between illustration 1 and illustration 4. Okay. So again, remember, he's earning 5,000, right? But the rent is paid quarterly, and it's like this. Even though we have paid the rent for 12 months, only 3 months relates to our period. July, August, September, October, November, December, Jan, Feb, March. The last rent is April, May, June, which is it's for the next year. So the last 3 months is not an expense, although we are paying it this year. It is an expense for the next tax year, and according to the which method is this accruals basis, we will only account whether it's income or expense. We will only take for those that were incurred or were due this in this period. We don't care when the cash was paid or received. We worry about how much of that income is for this year. And again, 5,000 is the income for 12 months. So the monthly income will be 5,000 divided by 12 is 416.66666. So the 3 months rent will be 1250. So think about it. The annual rent is 5,000. However, the rent for 1 quarter is 1,250. In this case, although we pay cash this year, the last amount paid is relating to the next tax year. I'm sorry, I think I'm confusing this. Apologies. See, the annual rent is 5,000 and the rent for 1 quarter is 1,250. Yes, I've confused this a little bit. Right? Here we are worried about, again, we don't care when did we receive. Yes, I think the logic is the same, right? So we are worried about the expense that was incurred. Look at the accruals basis. We recognize income and expenses when they are due, right? So therefore, we will take rental income for this period as 5,000 minus 1,250. So rental income will be 3,750. Okay. In Hembre, we took the entire 5,000. Why? Because we paid cash this year. So we've taken that into consideration. But in Aubrey, we haven't taken the entire 5,000 because 1,250 relates to a later period. Now again, allowable expenses. First expense is redecoration. It is for this period itself. So 200 is deducted. And 400 is paid in May. I don't care when it was paid. I only care about when it is incurred, and it is incurred this year itself. So therefore, we will, as per the accruals basis, we will take this into consideration. Last time in cash basis, we had ignored it because we will deduct it only when we pay the cash. But in accruals basis, we are worried about when it is incurred, not when the cash is paid. So therefore, here this 400 is for what? It's for repair. Will be deducted. Therefore, it becomes you have rental income of 3,750. You have expense of 600. Therefore, as per the accruals basis, 3,750 minus 600, your property income is 3,150. With which illustration 4 is done. Illustration 4 is the same as illustration 1. The difference between illustration 4 and illustration 1 is illustration 1 was done using the cash basis, and illustration 2 done using the accruals basis. This is the only difference between illustration 1 and 2. Okay. I hope this is clear to everybody and there is absolutely no problems at all. Next is property business loss. Again, going back to this example. Go back to this example. Imagine I sell the pen for 10 rupees, but my cost is 20 rupees. In that case, what happens? I have a loss. I have a loss in that case of 10 rupees. So if there can be a loss when you are selling a pen, there can also definitely be a loss when you have a property business. Okay, I will re-put that there at the bottom so that it's clear. But now we're doing property business loss, one of the last topics of this chapter. Right? What does property business loss say? Property business loss. There is a high chance, okay, maybe not a high chance as such. Probably the word high chance may not be a good word, but there are chances. There are chances that the expense relating to a property is higher than income. For example, just you sell a pen. When you sell a pen, See, if the sales is 10, selling price is 10, but the cost is 12, there is a loss of how much? 2. There's a loss of 2. Here, there is a loss. A similar situation can be faced when dealing with property. Putting this on the fresh page. A similar situation can be faced, can be dealt with when there is a similar situation can be faced when dealing with property. What do I mean by that? I mean, maybe there is a rent received. For example, rent received is 1,000, but expenses are 1,200. This means that there is a loss. There's a loss of 200, and that's it. If you understood this, you understood what property business loss is. It's as simple as that. Right? Now, again, we will look at understand this better with the help of illustration 5. So if you are to look at illustration 5, Sheila owns 3 properties that were rented out. Her assessable income and allowable expenses for 2 years to 5. Now again, there are certain rules which I'll explain with the help of illustration 5. Okay. Again, let's look at her income in 2023-24. Sheila, first property, property 1, P1 I'm putting it as, okay. P1, property 1, income is 1,200. Expense for the property in that year is 1,850. So you see there's a loss. How much is the loss? There's a loss of 650 if I'm not mistaken. If my calculations are right, there is a loss of 650. There's a loss of 650. Okay. Then what happens? Her second property. Same way you will do. Income is how much? Income is 450. Expense is 450, 600. So again, there's a loss of 150. And what about property 3, P3? P3 is income. Again, I'm only doing the first year. Okay, 3150. Expense is 2550. So this property has a profit. Profit of how much? 3150 minus 2550 is 600. Now that you've done this, we will look at the second year. But remember, (3150) minus, yes, sorry, this is expense, right? So the expense is 2,800. So expense is 2,800. So 3150 minus 2,800 is a profit of 350. Now, one thing you need to know is this. The profit and losses on all the properties are aggregated to calculate the assessable income for the tax year. So it means I have 3 properties, but I will take the aggregate. First property has a loss of 650. Second property has a loss of 150. Third property has a profit of 350. So the aggregate profit or loss is 650 There's a loss of 800 and there's a profit of 350. So there's an aggregate loss, total loss of how much? There's an aggregate or total loss of 450. Guys, I hope this much is clear. Aggregate loss. The aggregate loss is 450. Now this can be carried forward where from a future period you can deduct this. Now that's a good thing for you. What do I mean by good thing for you? The aggregate loss, I can take it for a future period. Let me explain what I mean. Again, going back to illustration 5. Again, this is, I'm putting it in black because I have to remove this drawing. Right? Again, P1, P2, P3, I'll do, but for the second year. P1 is how much? Second year, there's an income of 800 and there's an expense of 900. 800 expense 900. So there's a loss of 100. What about P2? P2, there's an income of 1750. There's an expense of 950. So 1750. Expense is 950. So 1750 minus 950. 800. So there's a profit of 800. And P3 is 2550 minus 2700. Income is 2550. Expense is 2700. So there's a loss of how much? Let me just see that. It is, where is it? Okay, it's very confusing. I'll just do it on my 2550 minus 2700. There's a loss of 150. So in the second year, there's an aggregate. We need to know aggregate profit or loss is how much? Minus 150. Sorry, 100 is a loss. 800 is profit. 150 is profit. So we have a profit of 950, out of which 100 is a loss. So we have an aggregate profit of 850. So 850 is the aggregate profit. $250, where is 250 loss? First one is 100, second one is 800, third one is 150. So there's an aggregate profit in the second year of 850. Okay, sorry. Yes, you're right. This is a loss. This is a loss, correct. So the aggregate profit is how much? 100 plus 8, sorry, 100 minus 250. 800 minus 250. See, 550 is the aggregate profit. Because there's a loss of 100 plus there's a loss of 150. So 250 is the loss. Profit is 800. So 800 minus 250, aggregate profit is 550. Now, one interesting thing that you need to know is when there is an overall loss, like in the previous year, in the first year, there was an aggregate loss. So there will be no tax obviously charged, right? So if there is an overall loss, the property income for tax purpose will be zero, nil, and that is what this is. But any losses can be carried forward. What do I mean by carried forward? Second year, you have a profit of 550, correct? You can deduct last year's loss. Last year had a loss of 450. So therefore, you can say my property income for this year is 100. Because the old previous year's loss has been carried forward, right? And we have deducted it from the second year's profit, and we will say that the property income that will be taxed is only 100. Guys, I hope you're clear and comfortable with property loss. And illustration 5. Any problems, guys? Neha, Chirag, Aditya, Ashank, Sujay, Chirag, perfect. So illustration 5 is also done. Illustration 6, you can try it on your own at home. Now we're going to look at lump sum amounts. Remember I told you when we looked at property, I said you can earn rent, you can give out your property on rent, or you can lease out the property and you can get a lump sum amount. That is what we are going to look at in this section, right? So we finished the first section, which is the major section. As I said, for this section, the last topic was property business loss. Now we're moving to the next heading, which is where you lease out your property for a short period of time and get a lump sum amount. Okay, and that's what we're going to look at in this section, which is, so basically this entire chapter is split into 3 sections. Premiums received on the grant of a short lease. So these 3 sections, you can say, the chapter is broken into. Okay, so let's look at that. Premiums received on the grant of a short lease. Now, in this case, what do you do? How do you deal with this situation? Right? See, this is basically a premium is what? This is a lump sum amount you receive from a tenant when you give your property out on a lease. Right? So now that raises another question. What is a lease? Lease is when you, the landlord, when a landlord gives a tenant the right to use a property for a fixed number of years. Okay, for the next 5 years, for the next 21 years, you can use this property, and then for that, the tenant will give you like a lump sum amount. After which, again, so it's for a short period of time, the property is given. For that period of time, the tenant gets exclusive access to the property. So for that number of years, the tenant gets exclusive rights to the property. Right? Now, again, here we're going to look at specifically what is a short lease, because we said we get premiums received on the grant of a short lease. So when will you say short lease? Right? Short lease is a lease or giving out a property on lease for a period of 50 years or less. That is what would be a short lease. Anything more than that would definitely not be short. Now we have to calculate the lease premium. How will I calculate the lease premium is what we have to look at. Right? Again, there are two formulas. Both formulas can be used. Remember, these formulas are not included in the tax rates and allowance provided to you in the tax exam. So you'll have to remember these formulas. All right. What are the two formulas is what we will look at over here. The first formula is here. Whatever is the premium minus premium into 2% into N. N is the number of years for which the property is leased out. Minus 1 is the property income. Either that or the other formula is property income is premium into 51 minus N. N again is the number of years for which the property is leased out divided by 50. And you'll understand this better with the help of illustration 7. Illustration 7. So what do you do here? Illustration 7. Wakana granted a 21-year lease. So here you know automatically N is 21 and this is a short lease because it's less than 50 years. Premium is how much? Premium is given as 10,500. So you just have to find out how much is the property income. I'll just use the second formula. You can use the first formula. Second formula, both are equally easy, guys. I mean, you just have to substitute the numbers into the formula. Second formula is what? Premium into 51 minus N. N divided by 50. So here the premium is 10,500 into 51 minus N. N is how many years? 21 years divided by 50. So 51 minus 21 is 30. So it's going to be 10,500 into 30 divided by 50. Right? So I'm doing my calculation. So I'm not quite sure, but if we do this way, then it becomes 51 minus 21. 51 minus 21. So I'm getting the answer of 6,300. 10,500 into 30,000, 30 by 550. 30 by 50 is 0.30 by 50 is 0.6. So it becomes 10,500 into 0.6, which is 6,300. So your answer is 6,300. End of story. Property income is 6,300. Same thing you can implement in the first formula also and calculate. You can do whichever is easy for you. Right? So the answer is either way, you get the answer of 6,300. With which the second part of the chapter is done. Now again, the last part is FHA, furnished holiday accommodation. That's the last part we're going to look at because, I remember, sorry, there's one more thing, renter relief, but I'll talk to you about that in the end. So yes, you can say this chapter is broken into 4 parts. Right? The fourth part is renter relief. So we've completed the first 2 parts. Now the third part of this chapter is where you have FHA, furnished holiday accommodation. How do you deal with furnished holiday accommodations is what we're going to look at in this section, which is the third section, which is as small as the second section. So don't worry, don't panic much. So furnished holiday allowance. So if I have to do furnished holiday allowance for you, furnished holiday allowance, furnished holiday lettings, if you want to call it. So in this case, what do you do? Remember, this is a property. A property is number one, furnished, number two, rented out, and number three, used for short term. Okay, now we'll elaborate on how it is taxed and what is short term, when do we say it is short term and all that. But this is what will be a furnished holiday allowance. It has to be furnished, it has to be rented out, and it has to be rented out short term, right? However, the time period that we're talking about, we will look at. Right? So here, what do we have? Is this here? Again, it needs to be furnished. Say there is a bed, there are sofas, there's kitchen appliances. It is rented out and it must be for short term, but it must be rented out. See, short term means what? Okay, one person comes and stays for 5 days, another person comes and stays for 10 days, another person comes and stays for 20 days. So it's like short term. But overall, in a year, it must be rented out for at least how much? 210 days. It must be listed maybe on Airbnb. It must be listed out for at least 210 days. It must be available for rent. Let me fix that word. It must be available for rent for at least 210 days in a year, right? And in those 210 days, it must actually be rented out for at least 105 days in a year. So again, it needs to be available for rent for at least 210 days in a year, and it must actually be rented out for at least 105 days. And remember, it's a short term stay. It must not, even in that same point I'm adding, it must not have long term tenancy. I mean, one person cannot come and stay for 1 year. Then it is a long term tenancy. It will not be short term. So it must not be rented out to the same person for more than 155 days in a year. Not be rented out to the same person for more than 155 days in a year, because in that case it will become a long term residency in that property. Right? The property must not be let for periods of long term occupation in excess of 150. So once that is clear, and also continuously, if it is let, see, in total we are talking about 155 days. Maybe one time I will come, you have a property in London. So one time I'll come and I'll stay for 15 days. Then again, I'll come after 2 months, I'll stay for 15 days. That total should not be 155. And also at the same time, continuously, it should not be for more than 31 days. Because if it crosses 31 days, then it is continuously. If it crosses 31 days, then it will become like long-term occupation. Right? So long-term occupation is defined as a period of more than 31 consecutive days when the property is let to the same person. It is possible for the property to be let to the same person for more than 31 days. However, when aggregating all such periods of long-term occupation, the total must not exceed. As I said, the total period should not be more than 155 days. So for now, you can just see if you're comfortable with these 5 points. Just see here. Make a note. Let me know if everything's okay. So I hope, guys, this is clear and easy for you. Now, again, there are no sums as such in this specific chapter for this. And there's rent a room relief. Again, just a little bit of talking through, after which this will be done. So tax treatment of FHAs is the next thing that we're going to look at. First thing is, this is treated as a separate business, meaning that FHA income will not be kind of totaled with other rented property. What do I mean by that? They are treated as arising from a separate trade carried out by the landlord and are not pooled with other rental property. Income will not be pooled with other rental property. This has to be calculated separately. To be calculated separately. I hope the first point is clear. Okay. Then what is the next thing that we look at? Finance costs. In this case, see, in the previous case, we said that, up to a 20% relief we will give you. You remember? Here in finance cost, I said I'll give you a relief of 20%. Financing cost, illustration 2. But in this case, finance cost, there is a little bit of a relaxation. I think I've gone a little too below. Here, in this case, the finance cost itself, the finance costs are fully deductible. Unlike regular property, where you just get a relief of 20%. Right? So that is the better thing about short-term rentals. The entire finance cost is entirely deductible. Right? Here, losses of FHAs, because we're treating it as a separate business, can only be carried forward and set against future FHA profits only. You will not deduct losses of FHA from other property. Remember that. Any losses made in qualifying FHA business may only be set against assessable income of FHA business itself. You cannot deduct FHA loss from other property. Right? Then coming to plant and machinery are deducted. All right. So this is what is the treatment of FHA. Just make a note, see if you're comfortable with this. And with that, we move to renter room relief. Okay, guys. So the last topic of this chapter, I have another 5 minutes. So renter room relief is a very small topic. So we can kind of complete that today itself, with which the fourth chapter is done today. Renter room relief. Okay, so as I said, this chapter is broken into these four parts. Right? We've completed the first three. Now we're looking at the last part, which is the renter room relief. How do you do renter room relief? Very simple. Now again, I'm putting it in bold, but this is what it says. It says that this applies, see, in your house itself, in your main home, in your main residence, maybe there is one spare room, correct? Maybe you don't use all rooms. So in your main residence, if you rent out a room, that is a rent a room, basically. Okay. In your main home, you rent out a spare room, basically. Again, there is a certain relief that you will get, which we will talk about. So you're taking in like a paying guest. Take a paying guest in your house. Now, if rental income is less than £7,500 per year, is equal to or less than, or less equal to or less than 7,500 per year, then what happens? Then there is no tax charge. Right? The income is exempt from tax. So it's a good thing for you. Oh, okay. So you can keep the rent at 7,500. So it is exempt from tax. All right. So that is what we have looked at. It says again a relief. So if an individual lets furnished accommodation in his or her main residence, we have something known as a rent room relief. And again, if your annual receipts are 7,500 or less, the income is exempt from tax. Okay. Now, to married couples, this rule allows a married couples taking in lodgers to either have all the rent paid to one spouse, who will then have the full limit of 7,500, or have the rent divided between the two spouses, and each spouse will have a limit of 3,750. So this is for married couples basically. I mean, maybe they own the property together, right? So either you can take in, there is a limit of 7,500. The limit of 7,500 can be, I don't know how to word it, but let me kind of make it easy for you. Basically, it's like, say, if a couple, see, the limit is 7,500, but for married couples, the limit of 7,500 can be split between them equally. Maybe there is a possibility that they are splitting the rent equally. So if they are splitting the rent equally, they might also want to split this relief equally. So 7,500 divided by 2 is 3,750. Maybe again, see, rent they are collecting, and that rent is split equally. So if the rent is split equally, they can split the relief also between them, where each person now gets 3,750 exempt from taxes. Guys, I hope this is clear to everybody. Okay. For now, that's all. I mean, we've completed this chapter. There is one small topic left, post which we will move to employment income tomorrow. And I will try my best to also complete employment income tomorrow, such that we can on Tuesday move to the 6th chapter. And remember, employment income is a fairly large chapter. Okay, but I will try my best to complete it tomorrow. Okay, because again, we have to also know that we need to finish the syllabus on time. However, for today, these are the topics that were covered. Okay, go through it. Meanwhile, I will take your attendance. Just give me 1 second. I'll show you the textbook, my notes. Just give me 1 second. Today is the 3rd of April, and my God, I have 4 classes today. 3, 4, 8.5 hours of class today, out of which 3 hours is done. So I have another 5.5 hours of class. You can see side by side. I mean, you don't need to see the attendance because that's not of your use, but you have the screen in front of you, the things that I covered today. So just have a look at that. Last 10 minutes, it's a review time. Okay, so let me know how much is your understanding and overall satisfaction out of 5. You can even include speed. If you feel that the speed is slow, you can maybe give a little lower rating and say speed, I want faster. Or if you feel it's fast, you can say speed, I want slower. Anything. This is your overall happiness for the class today on a scale of 0 to 5. Just go through and let me Guys, again, your whatever your rating is, please give it. Okay, guys, so that's all. You can leave. I'll see you in tomorrow's class. Thank you so much.